Hello and welcome to the PINCast, the podcast presented by myself, Richard Bowser, editor and founder of Property Investor News, the monthly magazine which we launched 20 years ago back in 2002. If you want to listen to factual, no-nonsense interviews, insight and opinion from some highly experienced and respected property professionals, then this is the podcast that you really need to tune into on a regular basis. Hello, it's Richard Bowser here, editor and founder of Property Investor News, and welcome to our latest podcast. Today I'm joined by Mike Bristow from Crowd Property, development lender. I talk with Mike about what's happening in the development sector and finance, and obviously with rising base rates from the UK government affecting us all, we look at what's happening in the property development sector, talking about labour, material costs, what investors, developers need to be considering in terms of their occupancy strategy. Talk about build to rent, we talk about developing to sell. And what changes have we seen in developers' mindsets since the calamitous autumn budget from Liz Truss? We also talk about the impact of energy rises on developments and the end product and what customers needs. So there's a lot to talk about in this podcast, and myself and Mike go through it in some detail. Hope you find the PINCast of interest. I'm Richard Bowser. I'm the editor of Property Investor News magazine, and today I'm joined by Mike Bristow, who is the CEO of Crowd Property. Good afternoon, Mike.
Hi, Richard. Great to be here. Great to see you.
Indeed. Thank you for joining us. So, Mike, without further ado, let's just you tell our audience, some of them we were very well aware of what Crowd Property do, but there are going to be people listening to this in the weeks and months ahead who have not heard of Crowd Property. So explain what it is that Crowd Property do.
Thank you. Yeah, so we're the UK's leading specialist property development lending platform. What does that mean? We fund property development. That's first and foremost what we've built. We founded this business back in 2013. Now started lending in the end of 2014 because we felt and experienced ourselves that lending to small and medium-sized property developers, quite frankly, wasn't very good. And so we set about changing that by building a lender that's based around property finance by property people, because fundamentally we are property people and really understand what it's like being a developer and the complexity and difficulties of undertaking developments. And we felt that we could, support people better in that and fund people better in that. Really our mission statement is to transform property finance to unlock the potential of small and medium-sized property developers, to build more homes, helping them grow their businesses quicker and drive spend in the economy on labour, materials and services. And we should never forget that it's a fundamentally important part of the economy. Each home built or not built is worth circa £100,000 to the economy on labour, materials and services. It's not just about asset expenditure. So the government and all of us have a big job to do to build enough homes, which we are fantastically bad at doing, and we hope to be unlocking more and more of that. And just to give you a quick few figures on that, we've now funded the development of £665 million worth of property. That's 2,988 homes. This will probably be out of date tomorrow, let alone when someone listens.
Yeah.
And we've agreed £368 million worth of facilities against those property assets. And all of that only happens if we deliver on our promise that is supporting those small and medium-sized developers better than anyone else in the market. And so we're sort of super proud of where we got to, but this is still just the start.
Yeah. And was it just under 3,000 actual homes that you've financed effectively so far?
Exactly.
Yeah. Clearly, given the government's lauded targets, which, as you've already said, never ever get anywhere near being met, there's a lot of scope to growth for Crowd Property for sure.
Well, exactly. And the really interesting thing on that is that, the UK is spectacularly good at building 200,000 homes. The problem is that we all know we need more like 300,000 homes a year, but it's very consistent. And it's actually the makeup of that that's really interesting. So over time, sort of pre-global financial crisis, about 30% of that supply was built by small and medium-sized developers.
Indeed.
And then wind forward 10 years to 2017, 2018, and that was 10%. And one of their biggest challenges was the finance and the service around that finance, which is where we decided to focus and build a better proposition to deliver on that mission.
Great. So, Mike, you've clarified on your company's role, and we talked about the market and the challenges, obviously, in terms of what's been going on recently. I mean, I remember something like, was it 40 or 50% of SME developers went out of the market some 10, 12 years ago after the financial crash. And as you say, finance was very difficult to get post-credit crunch. So what are the challenges now that you are seeing in the marketplace from a development perspective? And we're talking primarily small-scale development there, SME developers. What are the challenges? What are your thoughts on what they're seeing currently or experiencing in respect of, since that crazy budget in the autumn, the quasi-Kwarteng and trust budget, and then the knock-on effect of that with, interest rate, bank rate rises as a consequence? How has the last sort of 4 or 5 months been playing out? And what are you seeing at the coalface? Because you're at the coalface, your team are dealing with inquiries on a day-to-day basis from developers looking at putting potential projects together.
Yeah, so we get a pretty good read on the market. So we see about 300 to 400 million pounds worth of applications a month into our business. And we talk to every single one of those developers because we're building a relationship with everyone here. And I'll start with the data we see internally. So in broadly, the housing starts, which is the measure of house building.
Yeah.
So the number of units being started, which then 5 quarters later hopefully turns into houses finished, right? But macro data on that in the UK is that's broadly flat over the last 3-4 years. Okay. Obviously it had a dip through COVID, right? And however, within that, we saw the facilities that we agreed between Q1 and Q3 last year was up 76% on the previous year, right? So we saw a lot more, backed a lot more of the market and grew market share. Then that softened in Q4 where developers got a bit more uncertain and they were looking to just delay things a bit and just sort of see how things play out. There was a lot of uncertainty, which is very natural in the market, okay, from a developer perspective. However, many were also getting let down by their finance providers.
Yes.
And we saw that in our directly competitive space in development finance, but also in our refi space where term lenders, where people were keeping it or even where they were selling it, right? Term lenders were digging their heels in and just asking more and more and more questions, which is a typical delaying tactic. And so the finance market was pretty bearish in Q4. We had a different view to that. We had a view that said, look, we will look at our credit policy naturally in any sort of periods of slightly greater uncertainty. And we picked sort of certain areas where we particularly wanted to back and a couple of areas where we just reined in our credit policy a little bit. But we were very actively lending when everyone else was sort of pretending to lend, i.e. asking questions, but weren't really lending. And so we saw growth during that Q4, not quite as good as the growth Q1 to Q3, but that was largely because fewer developers were proceeding with sites. There was quite similar to COVID, actually,
right?
In that, developers are a bit uncertain, number one. And number two, the bit that really, really affects the market and really, really affects the contribution of construction to the economy is the unreliability of lenders, right? And so we saw very similar patterns to COVID where banks retrenched more
Yeah, very quickly.
Than they would rationally.
Yes.
And non-bank lenders, who typically have wholesale lines of capital from asset managers or similar, and often only single sources of wholesale capital that aren't necessarily contracted very well, they basically said, well, we're pausing, so they weren't lending. So therefore, developers were uncertain on what's going to happen to GDP, whether they get finance, right? And then there was the whole sort of the media frenzy that put together cost of living crisis, base rates up, inevitable recession, deep recession, et cetera, et cetera. So all of those things together, it was a pretty tough time for many developers. Saying that, in softer times, it's often a great time to go and undertake projects, whether it's companies building, sort of tech infrastructure, or car manufacturers designing supercars, or developers thinking, well, if I can get a reasonable price on this land, and in 2 years' time, there should be less uncertainty in the market. So you see progressive developers snapping up really smart and sharp deals, and they're the ones that we were very much backing.
Yes.
In that market.
Yeah.
But I think one of the things that is probably quite an important myth in many respects. There's quite often people get fearful of material cost inflation.
Yes.
Right? And they often conflate that with the cost of living crisis. Right? And the cost of living crisis has been around for last year. Material cost inflation has been around since basically the pandemic, accentuated supply chain issues, which were exaggerated by the Brexit situation, all of this, right? And so we've seen cost of material inflation for years. And actually, there's a lot less uncertainty in that now than there is maybe with utilities prices. Now, the good example of that is something like lumber. So it's a timber futures market, which is a global market, where it's down at pre-pandemic levels, price of timber, right? At least the wholesale trading price of timber. But developers still need to dig a hole in the ground, and that takes energy, right? So there are elements of the input cost stack that are still challenged, but there are elements that are a lot more favourable and less uncertain than they were. So, and we see a lot of developers understanding that and realising that and saying, actually, do you know what? Maybe now is the good time to strike when vendors are sort of reassess their expectations for the land value.
Yes, I was going to ask you about.
Value to convert. Yeah, and there's opportunity. Any market like this presents opportunity. But the final point to this, I'll just run. There's a couple of things. We now run what we call the Crowd Property Developer and Investor Index, where we ask developers and investors different things. And I'll just tell you what they said to us. So this was a December survey, and we're just about to go to market with the latest survey. So in the overall economy, developers were most fearful of, number one, fear of recession.
Yes.
Number two, inflation. Number three, central government policy. And number four, Bank of England base rates. Now, it's quite interesting that base rates were so low.
Yes.
And specifically within the property market, the things that they were most concerned with are, number one, lack of sites that stack up. Number two, obtaining finance. Number three, material cost inflation. And number four, planning policy. Right. Now, so some of those we're not working to solve, but the obtaining finance is always high, right?
Yeah.
And that is the fundamental pain of what we've been working on. And 70% of people expect obtaining finance to be harder or significantly harder over the coming 12 months.
From where we are now? Yeah, and you've mentioned negotiations with landowners on this. Clearly, when the numbers change because of bank rate changes, etc., knock on a cost of finance, throwing previous numbers out of kilter, out of sync. I mean, how are you hearing, or what are your observations the way that landowners are responding? Because we had a great quote recently about just the general market for property trading, and the quote was, buyers think it's 2008 and sellers still think it's the middle of 2021. I think that was the observation.
So, I mean, humans don't like change.
No.
And there's two humans in or many more in the party of the transaction.
Yes.
So rarely do they meet in the middle. So look, the reality on sites and site costs is you have to go back to fundamental residual value calculations, right? I.e., what can I sell it for? What's my expected margin? Take that off. What's my cost base? Take that off. Then it relieves the land value or the asset value,
yes,
the thing you're going to convert. And that is rationally the value of the original asset.
Yeah.
Now, there are variables in that, and whether people can build quicker, better, etc. Their view on cost, their view on procurement, their scale of procurement, whether they're in-house contracting or externally contracting, all of these sort of variables, right? But, no matter how rationally, no matter how well you break it down, it doesn't always land with landowners to say, I'm therefore rationally going to sell it. Because what I think you saw quite quickly is when material costs went up, residual values went down in a greater scaling effect.
Yes.
And therefore, if a landowner looks at an offer on a rational residual value basis now, they may also think, well, what happens when that material costs, when they unwind, when they come down, when, the reverse effect on my residual value will happen. And they may be in a position to say, look, I'm just going to hold for a year. So it all comes, as we all know, it all comes down to situations of the vendor and whether there is, whether they're willing to accept a rational argument, whether they've got patience, whether they can take their time, etc. But one thing we do see, and we structure quite a lot of these, is support on structuring of JV deals of whatever.
Yes.
Whatever sort of, ultimate aim that tries to achieve. And structure, whether it's pure equity joint venture, you sometimes have overages and all of these sort of things, profit shares.
Yeah. Fine.
And, you can get creative. Development is much like, the basic of investing as well. Get to know the vendor, understand the situation, get to know their needs and wants, etc., and see if you can structure a deal around it. Because any deal you structure, a solicitor can put in black and white. And that's the important bit, is that putting it in black and white so that everyone's clear and protected.
Okay, great. Mike, one of the things obviously we've been reporting on in Property Investor News for quite some years now, and which there's been a lot of, I wouldn't say hype, but a lot of media reporting and to some extent doom-mongering towards private landlords is the concept of build to rent. And again, we've been doing some analysis in the magazine over the last year or two, and the actual number of units being built relative to, as you've already highlighted, house building targets, but also, as we also know, post-COVID, particularly in the last year and a half, rental supply is not keeping up with rental demand. So clearly the case of build to rent is very strong, but at the same time, build to rent developers have similar challenges to what developers doing build to sell have. And we've already highlighted some of the items that any developer, whatever the end usage, is going to be dealing with, such as the cost of finance, the cost of materials, the cost of labour, etc., etc. So what are your thoughts on development on a build to rent model? I mean, obviously you provide the development finance, whereas build to rent, obviously there's going to have to be, unless incredibly cash rich or institutionally backed, it's going to have to be funded. What are your thoughts on that market?
So I think this is really interesting. So let's sort of, if I just wind right back. Okay, so in 2002, when I started investing in property, I could buy a flat, rent it out, wait 2 years, refinance it, buy another. Right? There was nothing sophisticated about it. It was easy. And when things are easy, it attracts more and more competition.
Yeah.
And extraordinary profit comes out of the market. Right? That's market dynamics. And so it was always going to get sort of more complex, and profit margin was going to come out of pure property investment. And then also you've got tax overlays on that.
Yes, indeed.
So a natural trend that we expected, and we are very much seeing, is people building and holding. Right? And, and that makes perfect sense, okay, because not only is portfolio building a good principle, long-term wealth creation principle for individuals, it's also a way that you can say, well, I want to be an investor, but how do I add value early on so I can use my capital more efficiently and recycle it a bit more and all of this? So why don't I build it and then let it? And then the interesting thing you've got overlaying onto that is, well, if you're building it, you're probably building it well, right? And because you're going to think about longevity of it, maintenance of it, and energy efficiency of it, especially if it's like a multi-let HMO because you will bear those bills, and so actually there's some bigger picture themes there as well. So this is very, very much a trend, and we're supporting more and more of this, and we like it for those various sort of dynamics. The other elements to it are, I think, sort of over the long run, small and medium-sized sort of investors and maybe developers as well, I don't think they've been brilliant at treating their property business as a business.
Mm-hmm.
And what I mean by that is thinking about business strategy and having clarity of strategy and executing on it. Now, what is strategy? So I spent many, many years as a strategy consultant. And basically, it's a combination of customer, of market, of your own capabilities, and the competition that's out. And if you think about all of those factors in your end product, i.e. what you want to let out in the market, okay, then you can, if you're building as well, you can build that in.
Yes.
So you can be better than the house, the rental unit next door, round the corner, down the road, beat the market, set record room rates, have that desirable property that's better than your relative competitive set, right? That is business strategy. That is executed best if you're also creating the asset that you then let, right? And so I think that's a fascinating thing that people are getting a bit more strategic about. And then my final point, illustrated this with hard data and then an anecdote as well, but if you look at major forecasters for the property market going forwards, so some of the big agencies, and although it's not always advisable just to listen to the agencies, it's sort of turkey's waiting for Christmas, but also the sort of the more grumpy economists as well. And you look at it, and it sort of says, net with some ups, some downs and then ups, et cetera, over the next 2 or 3 years, it's probably going to be roughly flat. The property, the house prices overall. So Savills said a few months ago, they said, well, we reckon, by end of 2025, it's going to be rough 0.7% up overall, so flat. And Knight Frank said, I think, a couple of points below in 3 months ago. But both of them said over 15% rental increase.
Indeed.
Right? And that's your supply side point.
Yeah.
Right? The supply of rental property is constrained. People are coming out of the markets. I think that everyone said that when Section 24 kicked in, landlords would start selling. They didn't. When Section 24 phased in fully, that tapering in, really
2 years ago that was,
Everyone said, right, they're going to leave the market, right? And they did. Right? Then a year later, that 100% first hit them on their tax returns, and everyone said they're going to leave the market. It's like, no, they didn't, right? Okay. Then COVID hits, right? Are they going to leave the market then? No, they didn't. Right? But this interest rate piece, I think, is the straw that broke the camel's back.
I think it's got accumulated.
this basis, and they will exit as those fixed terms come out. And I think that will be the material observation of this exit of the landlord.
Yes, it's just an accumulation, as you say, the autumn budget, the disaster around that, and then obviously fixed rate deals suddenly going from sub 2% to plus 6% or whatever. That's really precipitated. Yeah.
And then a final anecdotal illustration of this. I have one of my units in southwest London came up just before Christmas. Let it about 3 weeks ago. That was a 30% rental uplift.
Yeah.
Right? And it wasn't underpriced.
No.
Before. But we're really going to see that rental uplift. If you can overlay that natural market rental uplift with designing and building product that's superior to anything else and marketing and achieving a premium on that is how you get sophisticated as a developer, investor, portfolio builder, etc.
Yeah. No, absolutely makes perfect sense. What you've just said certainly rhymes with my thinking. Yeah, absolutely. No question about it. So we're talking again, the SME developer for build to rent schemes, large scale HMOs or whatever. The financing side of that onto long-term finance. Explain to listeners how that works. You put structure the short-term development finance. How do people then get the long-term finance for because obviously
And this varies a bit by product as well, but this is because we're property experts and geeks at heart. This is all sort of core working with our developer customers, type stuff. But so generally it's you're either you're on practical completion, building control, sign off, etc. You've had your initial conversations in the market to say, right, let's move this on to term finance.
Yeah.
And we have really good intel in the market because we've got many different 380 projects backed. That sort of says, right, who's a good lender at the moment on the term finance side, who's not? Because some are just dragging their feet, being really slow, and that gets costly.
Yes.
Some are not really lending, but pretending to be. Yeah. Some are active, and we're seeing them executing really well, and it's advantage to go with them. And it's about planning ahead for that. We have seen some examples where you've got to be really careful on timing. So there's one example was quite a large HMO where it was coming to completion. One part of it had been finished. One room had been rented out as a 30-bed scheme.
Oh, right. Okay. So reasonable size. Yeah.
The broker suggested getting valuation then and sort of cracking on into the term market. Right now, if the value goes in and there's 1 out of 30 rooms let, there's no way they're ever going to look at that and say, well, this is a slam dunk proof point, right? Really well done. That's an excellent route rate, right? I'll times it by 30 and job done, right? They'll never do that. That is a bearish time to get a valuation done. There's always an optimum time about how you balance that, the proof of the asset, the proof of the cash flow, the proof of the ASTs in place. And then the optimum time then to get the valuation in with as much evidence that they can build their case on, and build that up. There's often a sort of a blame game used where there's an appointed surveyor from a lender, a term lender. They go in and they down value it, and the owner or the developer or the investor will just say, hey, look, well, they're just being told by the lender to down value it. That's not true. It's certainly not true in the vast majority of cases. It's definitely not true in our case. Look, it's you've got to help yourself on this. What is the right time for that valuer to come in? Maximize that valuation up, whether it's standard resi, standard buy-to-let, small HMO, or into commercial finance world. Whatever it is, give the valuer reason to back your estimate or to form a favourable estimate for yourselves. That's probably the pivotal bit. And we help throughout that. There are some asset classes where that matters less. For example, if you're just selling units.
Yes.
Some asset classes, it means more, like for an HMO. Some assets, it's vital. So for something like service accommodation, you need more evidence.
Yes.
And so, it's a big it depends story. But there's quite a lot of uncertainty. There's quite a lot of ways that you can either hinder yourself or help yourself in seeking that term finance right now.
Right. Obviously, if you've got a 30-unit building and it's all done and dusted and you've actually got 30 occupants in there and they're at a 15-20% premium to what anything else is letting in that local area, the evidence is very clear and the valuer can obviously put together the numbers much easier than if using that one example you quoted, if just one room is let and 29 are unoccupied. Great.
Yeah, exactly.
Okay, Mike, you mentioned serviced accommodation. This has been, before we conclude, you see this as a growing sector. Obviously it had its issues during COVID, certainly, of course, in the leisure aspect of serviced accommodation, and some city centres were very underutilised because business travellers weren't there. What are you seeing in the serviced accommodation sector now? And I'm including that sort of serviced apartments. Obviously there's different subsectors within this broader term of serviced accommodation, furnished holiday lets, etc.
Yeah, it's quite interesting because from across the team, we all of us have done all types.
Yes.
Of tenancies, and actually last summer, it was before last summer, it was last spring. I said to myself, I've done literally everything as well myself.
Yes.
Across housing benefit supported, conventional, HMO, all of these sort of
things. Yeah,
I've never done service.
Right.
So I purposely took one of my portfolio that's down on the southeast coast and flipped it into a holiday let.
Yes.
Right? Because clearly it's a bit of a trend at the moment.
Yes,
but
absolutely.
also I just really wanted to understand the dynamics.
Yes.
Right, and this is what we do, right? We're property people.
Yes.
Okay, so we're gonna experience ourselves, and we know what it's like, right? And that's been fascinating from getting on the right finance product, because that's fundamentally important.
Yes.
Through to the right agent, the right marketing, the right service provision, etc., and how you build up a proof, and all of these sort of things. So first and foremost, we would have done anything that anyone is looking to do in the team, and we have some dedicated experts for each of those elements. But specifically on service, yes. So interestingly, we back residential property projects, right? And between resi and commercial, there's kind of there's some grades.
Yes,
right?
Absolutely.
And where we draw a line is service accommodation is in, hotels are out. Okay, that's our scope. Right? So we back them, we like them. There's more work on our side to understand fundamental demand of those assets. We think that some of those assets have to stand out. Definitely don't want to be in markets of oversupply, and we can get all of this data pretty easily to again help assess for us, but also assess for individuals as well. Look, should the end product be service accommodation? But we're very comfortable with it. It's a growing trend. It's complex and management intensive.
Absolutely.
There are lots of tools and providers out there that can really help.
Yeah.
And getting on the right sort of agency, the right listings portal to make sure you optimize that occupancy is important. So there's lots of dynamics to it, but we back it. And fundamentally, we're backing the project bit, but we are obviously interested in the outcome use, because that also influences the refinanceability of it, and then fundamentally the economics of the proposition for the individual.
Right. Okay, Mike, I didn't want to pin you too much on that. Appreciate the response there. So great. Well, look, you've answered a couple of key points a lot of people are considering at the moment, and that's certainly the build to rent and service accommodation sector, two niches which a lot of people have been considering, as you say, as the sort of the vanilla buy-to-let model is not quite as straightforward as it was 15, 20 years ago. So, Mike, as always, you and I could probably talk all afternoon. But
very true.
Indeed, whether so many of the listeners would want to listen to us talk all afternoon, I'm not so sure. But so I'm afraid we're going to have to draw this podcast to a conclusion. So Mike Bristow from Crowd Property, thank you for your time this afternoon. Can you just remind everyone what the URL for Crowd Property is, please?
Sure, crowdproperty.com, and you can apply for funding for your project in just 5 minutes at crowdproperty.com/apply.
Well, there we are. Mike Bristow, thank you very much for your time today. Thank you.
Thank you, Richard.
Thank you for listening to this latest PINCast from Property Investor News. Make sure you've subscribed to be notified when the next episode is released. Register for the PIN e-news service at www.property-investor-news.com, where you can also sign up as a magazine subscriber and get the monthly print magazine. By subscribing to the magazine, you can get access to 17,000 articles which we've published in the last 20 years, alongside some 300 webinars and video interviews.